From exploding loans and private credit portfolios to explosive growth in options trading activity and options-based funds, both professional investors and retail traders have a lot to ponder in this market. A market that has taken a few glancing blows, but that always seems to bounce right back. Is that a sign of resilience or recklessness? Is this the time to buy more or to start cashing in your chips if you profited handsomely in things like AI stocks and gold? And what lessons from past bouts of volatility should traders keep in mind today? I sat down with two of the sharpest experts in the business at our recent 2025 MoneyShow Orlando to get those answers. One was David Keller, President and Chief Strategist at Sierra Alpha Research. The other is Steve Sosnick, Chief Strategist at Interactive Brokers. In this double-length MoneyShow MoneyMasters podcast episode, you'll learn what they're watching and which portfolio moves you might want to consider making next. I'm coming to you from the 2025 MoneyShow Orlando. Today I'm speaking with Dave Keller with Sierra Alpha Research. Dave, how are you?
I'm good. It's good to be back, Mike. Good to see you.
Yeah, great having a few minutes to chat. We've talked a number of times over the last couple of years. You've been bullish sometimes, you've been cautious sometimes.
Yeah.
What are you seeing in this market right now as we're recording?
So my general process is primarily a trend follower. So my goal is to identify the trends and follow them as long as possible. And I would say my trend following toolkit still quite constructive because things are generally going up. Risk assets generally going higher with some notable exceptions we can talk about, but generally we're seeing a lot of strength.
Okay.
But I've also learned to think like a contrarian. So as the market advances, look for things that could be a warning of a potential deterioration. That's where I think some of those leading indicators have really started to fire. And there are a number of things that I look at, but a lot of it would be, breadth deterioration, momentum deterioration, right? The market keeps going higher, but sort of the later stage of a bull market, you start to have things start to slow down. We've seen quite a bit of that in both of those categories.
Nobody wants to be a Debbie Downer, but I think as an investor or trader, if you don't ask what can go wrong, you're kind of doing something wrong, right?
100%. And I mean, as a trend follower, I don't think that means you just ignore what could change. And so you have to think in terms of probabilities, right?
Yeah.
In any given moment, you have the most probable path, what you think is probably going to happen, and that's probably how you should be positioned.
Yeah.
But there are also these tail risks. There are things that could happen, even if they're unlikely, but I don't wait for that to happen to then figure out what I'm going to do about it. So thinking now, what would an 8 to 10% correction look like on the S&P? How could that actually happen? What signs today would maybe help me get ahead of that a little bit? Those are things that I think are worth thinking about before the top occurs.
Sure. As we're recording, we've seen a couple days of volatility. We had the recent, crypto plus trade-related sell-off at the end of last week. We've had some concerns about bank credit quality, a few banks that have started to stumble here.
Yeah.
What does that tell you? How concerned should we be about this, or is this just another thing that we're not even going to be caring about in a month?
I mean, the advance from the April low to where we're at now in mid-October has been punctuated by a number of things that could have taken the market out and could have disrupted things much more than they did. They really haven't, right? The market has quite a bit of staying power. I think that speaks to a lot of just the liquidity behind this move, the fact that generally there's a big risk appetite. There's still plenty of optimism, a lot of FOMO about the AI trade. Yeah. The markets can go up a lot longer and for much longer time than you think, just driven by those things alone. Having said that, right, I mean, I think the volatility we've seen in the last week is pretty reasonable, right? We've had a number of sort of garden variety pullbacks since the April low, a number that have kind of pulled back a decent amount, like 3-5%, but nothing more than that. That's actually understandable. That's very reasonable, even in a healthy bull market phase. The challenge is when it turns into something more significant. For me, the 50-day moving average is usually like just a plain vanilla, if nothing else. Are we holding the 50-day? The S&P definitely is. What concerns me besides banks struggling, because a lot of banks have looked pretty good, besides some of the other things you mentioned, is some of the leadership names starting to be vulnerable. Amazon is down to its 200-day moving average. Meta, others have not been making new highs. As a matter of fact, only NVIDIA and sort of the chip makers have really been making consistent new highs since August into September and October. So the previous leaders not continuing higher at this point, I think that's the biggest area of vulnerability I'm thinking about.
Got it. So Mag 7 to just the AI subset, and then, I get it.
So again, what you have to remember, the top, as I mentioned to a number of people here, the top 10 stocks in the S&P are the same weight as the bottom 450 at this point. So one of those names struggles, and that can really weigh on the S&P and certainly the NASDAQ. So we could be in a situation where the indexes, if you could define the market as the S&P 500, the index can struggle a little bit if a couple of those names aren't doing well. But that doesn't mean that a lot of other areas of the market, industrials, healthcare, financials, even defensive sectors, there are consumer staples that are breaking out here. So there are stocks that are breaking out. I think it's a really good time to sort of renew a focus on price action and looking for what's starting to work here.
So let's talk about what the bearish checklist or correction checklist, whatever you want to call it. What do you need to see to be, maybe if not jump off the trend entirely, maybe take some chips off the table?
So I think of it in three parts. I think of it as like leading indicators, things that kind of happen before a top. I think about coincident indicators, things that kind of happen as the top is forming, and then some lagging indicators. And I'll start off by saying none of the lagging indicators, which would be like breaking a key line in the sand, right? The S&P's holding support, making higher lows. You're not really seeing any, sort of trend following devices giving any signals. The early warning signs, I think, have all fired off, right? So the S&P and the NASDAQ have been moving higher on weaker momentum. That tells us we're probably in the 8th or 9th inning and not 2nd or 3rd inning, generally speaking. Breadth has been deteriorating for quite some time, right? So since the end of June, every new high on the S&P has been marked by less stocks regaining their 50-day moving average. It's right around 50%. So even though the S&P is right at its all-time high, half the S&P are already below their 50-day moving average. So it tells you there's some weakness underneath the hood there. The coincident indicators, I think, are really important. That's where you talk about leadership rotation. So do the previous leaders start to struggle? Do you see an improvement in defensive sectors? And I think that's where things have really started to change in the month of October. Utilities have been the strongest sector in the S&P in the last month. Now, utilities a little growthy, right, with all the energy needs of technology, but still traditionally a defensive sector, a low volatility sector. Consumer staples, healthcare, real estate, all starting to hook higher as the market is sort of chopped around a bit. So I think further improvement in defensive sectors could tell us it's a different environment than we've seen through the summer and now into the fall.
Okay, fair enough. I have to ask about gold because it's one of those things. We've been in this weird environment where both gold and equities have generally been rising, which is sort of not the way things have been
counterintuitive.
But now it's like every time I refresh my screen, gold's up another $10. It's up $100 a day. At what point do we have to worry about the signal that's sending?
I mean, great problem to have if you own gold, right? You keep checking and it keeps going higher. So what I love about what's happened in 2025 is it dispels one of those kind of basic premises. People have a lot of simple relationships in mind. If stocks are working, gold's a safe haven. That should not be working, right? They should move inversely. But market history is full of times. Just in the last 12 months, we've seen a number of times where they move together. And so, I think betting on a simple relationship is not a great plan because the markets are complex, a complex mechanism, a lot of moving parts. So I think the fact that gold is rallying tells you a lot about the dollar and the weakness in the dollar, sort of a safe haven, a hard asset that given the fact that the dollar has lost value, gold has done quite well. So what do you do about a position of gold? I own, full disclosure, plenty of GLD and IAU. Those are physical gold ETFs. I own some gold stocks through ETFs as well through the GDX. And I've done that because the charts are telling me they're working. For me as a trend follower, I'm going to want to follow that trend as long as possible. So I'm less of a fan of saying, all right, when it hits $4,300 an ounce, I'm out. You think more about the characteristics of the trend, right? So thinking of trend following devices like moving averages and other average true range based systems that will help you stay in that trade, they're all still in good shape. And that's why I would want to still own them. I think the problem for a lot of individual investors with gold, with AI stocks, is when something starts to work and it really starts to work, your bet becomes bigger and bigger. And eventually your portfolio is a gold portfolio. And that might not necessarily be what you want. And so I think what institutions do a lot better is trimming on the way up and recognizing the importance of having a good allocation, which means, I have taken some gold off the table just to keep the allocation to a reasonable amount, but I still have plenty of exposure. And what you don't want to do is wait for the thing to turn over. Then you realize how that concentration can help you on the way up, but absolutely crush you on the way down.
Your background and sort of, what institutions do, how they approach the market. I want to talk about that in just a minute, but before I do, you brought up the AI stocks. I mean, everybody talks about Palantir and all these other red hot names. Are you seeing anything technically, from your technical perspective, that worries you or not? And what should people maybe do with those kinds of names?
No, it's a really good point. I mean, so I would say what's happening now is there was sort of an AI trade where everything's kind of working because anyone that had anything involving AI, which is why all the companies are scrambling to talk about why AI is such a big deal. Now you're starting to see, I think, a little bit of diversification where, not all AI related things are going up. Now it's sort of, key names, right? Like, so NVIDIA is going up. But a lot of even the big mega cap growth names that have big AI exposure, big cloud exposure, like an Amazon, are not looking as good. So it's diversifying a little bit. I think the great example of the AI trade is you look back at like Cisco Systems in the late 90s, 2000s. If I told you in 2000, look, the internet is the thing. There's this thing called social media. Phone in your pocket's going to have greater technology than your laptop today. You'd be like, all right, I'm going to buy a bunch of internet names. That's going to work. It was a horrible trade for a long, long time. And Cisco's not a great chart. At times it has been, but it really took a while to recover. So just because we know a theme is going to be transformational, which AI is, that doesn't guarantee that one particular stock today is going to be the one that benefits the most from that. And that's where I think investors getting into trouble. Buying an AI ETF just because it has AI in the title, just because it's in the description of the company. Focus on the ones that are actually doing well. And so I would say from a technical perspective, it's a little more diverse now. And I think risk management is going to be key on the names that have had the run that they've had.
One thing that you said just triggered another thought in my head, so I have to ask about that. The risk management and sentiment. We just have ETF filings for 5 times leverage ETFs now on top of the 3. Yeah, there was just and it's not clear that they're going to get approved, but it's 5 times leverage for some various crypto coins and some of the companies that invest in them. Digital treasury. I mean, what does that say about sentiment? Does sentiment factor into your sort of methodology at all?
So back in the day, and I won't tell too many stories about time of fidelity, but we would often look at ETF issuance, and particularly when a fund would finally get approved, that usually told you that thing was done, because the time to get it approved, the amount of optimism that would have to be already priced into the market before one would be able to justify it. So extra leveraged ETFs in those spaces definitely don't make me feel great about the sustainability of those uptrends. I would say, Jeremy, a lot of those leveraged products, they're dangerous in the fact that most people misuse them, right? They are intended for very specific purposes. They're intended for short-term use, really day trading kind of things. Most people use a triple levered semiconductor ETF just as a way to juice their returns and have leverage opportunity. And again, that works on the way up, but they also work on the way down. And so the structures concern me a little bit. I'm not a fan of using them in my own portfolio, which is why I don't. But I would also say the fact that we're getting extra leverage tells you there's such a desperate need for that usually tells me we want to start thinking more defensively. So definitely a check in the not so bullish column, I would say.
Yeah, it was just something I saw the other day. I'm like, wow, that's 5 times. It's like we're outbidding each other. Do I hear 6? Do I hear 7? Well, as we get towards the tail end of the conversation, I want to, you're going to be speaking about 4 pillars of investing success here. It's not just buy this, sell that. It's how do you go about being a better investor and trader? Talk about some of the things that you think are important.
Yeah, this goes back to my time working with institutional investors, where we would really think about charting and technical analysis, which is my background, really understanding price and psychology and sentiment as part of a holistic investment process. It was one of the parts that you would use to structure a portfolio and understand risk and reward. And so for me, it's fundamental, it's technical. What do the companies do? What is the price action telling you about the sentiment around those? And making sure those are in agreement is important. The macroeconomic, which is sort of the overall environment. And certainly we've seen the impact of macro events and one-off sort of tail risk sort of things, I think are important. But behavioral is the 4th pillar, and I would argue by far the most important. I feel like people spend more of their time than they need probably on the macroeconomic side, thinking about inflation and tariffs and the Fed. All that's fine. But if I didn't know any of that and I just was a disciplined user of trend following and technical analysis, I could understand when that picture's changing and when investors are rotating and getting more or less risky just by looking at the action and how that's impacting their businesses. The behavioral is where I find people are very underweight. That's why my own brand is called Market Misbehavior. I find a lot of people we're hardwired to make poor decisions. We don't want to deal with that because it's the stuff inside our head that we don't want to think about. We want to compartmentalize it. But if there's one thing I think investors could do better, it's have an honest assessment of what you're good at and what you're not good at, and surround yourself with systems, processes, and resources to address those weaknesses. That's what we would try to do with professional portfolio managers to help improve their return. We just say, look, you're selling too early. You're always selling too early. Why is that happening? All right. This guy's going to meet with you every day and he's going to show you these are names you shouldn't be selling because they're not bad yet. And then that would make it better. And I think individuals avoid that because you have to understand that you're vulnerable and imperfect. And
I don't make any mistakes. Come on, trading.
Everyone's a perfect investor, right? But the bad times will come. So I think thinking of that behavioral lens and looking at your process from a behavioral perspective, that's where you can really make some dramatic improvements in things that are totally within your control.
Well, Dave, I really appreciate you taking some time out to chat here at the Money Show.
Thanks, Mike. Good to see you.
Take care. Today I'm speaking with Steve Sosnick, Chief Strategist at Interactive Brokers. Steve, how are you?
I'm doing great, Mike. It's great to be here. It's such a vibrant environment.
Yeah.
I really enjoy it.
Thank you. We're glad you could be here. Obviously, it's been very interesting the last couple of weeks in the markets. We had this stair stepping up into the right pattern. Now there seems to be a little more volatility. What are you seeing out there?
I still see a lot of enthusiasm for the market. In general, our customers remain very, they remain very active in buying stocks. In any given day, I look at our 25 most active stocks on our platform. And at any given time, 20 plus of them are more buying interest than selling interest. I'd like to think this could go on infinitely, but you do have to wonder at some point, does the money train stop? But it hasn't, because as long as the economy remains good for at least for the people who are active investors, they remain enamored with the markets. We also see our customers very eager to buy dips, that they don't scare them. I do have to wonder if it's becoming a little too automatic. But we can talk about that. But I think in general that's something that's worked. We did start to see a lot of people predominantly more interested in selling puts than buying recently. So I think that had a little bit of a turn last Friday, because that didn't really work.
Yeah, that was definitely a jolt. I want to get to that in a minute.
Sure.
First, I want to talk about the retail investment and buying the dip mentality. I mean, there's always that Wall Street's calling you biggest business forever with retail's dumb money, but frankly, buying the dip has worked, and it continues to work. Thoughts on that? I mean, the retail investor seems to be making out okay with this strategy.
Number one, I think if anybody thinks of individual investors as dumb money, they're not. First of all, I've come to this is my second Money Show conference. I've had every single conversation I've been peppered with very smart questions. So individual investors are getting better educated. I'd like to think that we're working on that in Interactive Brokers. I certainly know that we're working on that here at the Money Show. I think that's important, and I think that that investors are the amount of intelligence that I see applied to investing, partially because of the democratization of investing, has gotten so much better. You don't need to rely on an intermediary as much as you used to. There are still very important and good trusted intermediaries, but I think many people have a DIY mentality that's working for them. But I do think sometimes people lose sight of the historical perspective. I was in a conversation earlier today with someone whom I know to be an expert. She seemed a little surprised when I said the volatility environment is really abnormally high.
Yeah.
So I do think that persists. I'm not going to call it short-termism, but I do want to remind people that who've made very, very intelligent, clever decisions over the last few years have to recognize that there are sometimes broader cycles that require a little more perspective and a little less reliance, maybe just purely on what's working for you.
Let's talk about what happened recently. That Friday, I mean, the tariff kind of re-threat or reawakening of tariff threats. That market got hit. Crypto got hit a lot worse. Do you think that's the wake-up call, or is that just another sort of one of these many things that we see and then we just keep marching on?
They can be. Those are not mutually exclusive, actually. My immediate response to that was we were letting the steam out of an overheated system, and it needed to do that. Markets need to do that kind of thing. It's a question of how much is left, what's the residual output. I think in terms of crypto, where there are allegations of insider trading, it certainly exposed the dangers of leverage, where people I think have learned that leverage is a great tool when it's going your way, but a nasty feature when it's going the wrong way. I think you shook out a lot of excess in crypto. I think we shook out a little bit of excess in equities. I think it was a good reminder that you need to, things don't always move up and to the right in a regular pattern, and that's okay. There were no really long-term disruptions.
Okay. You have years and years of experience in the options market, so I want to ask, are there any signals you're seeing in the options market? Anything people should maybe look at as strategies in this environment that you think could potentially work in that?
I think, as with anything, volatility is something you buy low and sell high. And one of the advantages of volatility, to some extent, is it's much more mean reverting than stocks. Right? Stocks do this. Talk pointing usually on a podcast if you're listening. They can go straight up to the right. They can go straight down. There's no. They reach different plateaus. There's nothing that says after you. If you look at something like VIX, or just volatility overall more broadly, it generally reverts to some sort of mean. VIX, the long-term mean is in the high teens. So if you get well below that, you realize volatility is never fully outlawed. It's probably better to buy it than sell it. And I think what happened was, on Friday, we've seen a lot of people selling what I perceived as relatively historically abnormally low volatility. What happens is that flips to the other way. People want protection. I've always viewed the role of my market when I was a market maker. I was an umbrella vendor.
That sounds like a great analogy.
And you know what? If you're in a long drought, nobody wants the umbrellas. Good time to buy them, but nobody really wants them. Then all of a sudden, the clouds form. You got some more interest. If you get an unexpected rain shower, believe me, everybody wants those, and that's when you see VIX, spike up because everybody needs protection and wants it or realizes they're under hedge, whatever. But so that's the way I think about volatility. So look at historical volatility. Don't think of VIX as a fear gauge. One of my little mantras is VIX is not a fear gauge when it plays one on TV. It's not explicitly constructed to measure fear and greed or that sort of thing. I won't bore the listeners with the calculations. It'll take 20 minutes and everybody would turn off. So I don't want that. But what I will say is, it's meant to measure market expectations of volatility over 30 days. But again, like the umbrella analogy, if you haven't had a rain cloud in a while, people tend to perceive that to be normal. If it's been doing nothing but raining, you perceive that to be normal. That's how you want to approach options. Allows you as a hedge versus strategic portfolio investment.
Well, speaking of rainstorm, you told a wonderful story of the ultimate, not rainstorm. I'm not going to use the word I'm thinking of, but that kind of storm that would happen back in and that was the birthplace of the Fed put. You were on the front lines of what happened back in 1987. Just talk briefly about lessons you took away from that. We haven't had something like that, I guess, really since the great financial crisis. I think it's uncomparable. And what do investors or traders need to keep in mind about events like this?
I think the most important thing for equity investors to keep in mind is the Fed does keep an eye on markets, but they are not going to intervene specifically to protect equity investors. They will intervene to protect the system. And sometimes, a lot of times, there are times that the Fed needs to intervene because and the stock market is reflecting that. I think the last big intervention, I would say, would have been 2023 when Silicon Valley Bank ran into trouble and it started to metastasize around the banking system. So they realized we probably should do something to stabilize this. They did not intervene in the tariff change, which was a bigger stock market decline. But as I think about it, it was sort of a policy mistake. The administration has been has during the first Trump administration, and people were expecting a market-friendly administration. And there were policies that no one had tariff policies on their dance card, and then no one had an initial response from the president of the administration to be sort of like, suck it up.
Yeah.
And then that reversed. But the Fed was nowhere to be found in that. So understand there that the quote-unquote Fed put exists, but it's a systemic thing. It's not a stock market. And that's very important. So if you think you're avoiding hedging, I think a lot of people think, oh, why do I need to own puts if the Fed's giving me money for free? They're not the same.
Well, I think those are important words of caution, important things for people to hear. Steve, I appreciate your time here. Thank you so much for joining us on Money Show.
My pleasure as always, man. Thank you so much.